Friends, in the earlier part, we have seen the comparative study of the balance sheet, some financial statements based on the Indian Companies Act 1956, which is the Indian Companies Act 2013. There is balance sheet, we have seen it. And in the back end of that session, we have also stated that as a lender, as a banker, always see the financial statement to see various particulars, including the fund flow. Fund flow also we just touched it, saying that in case the borrower is not borrower has not submitted the fund flow statement, we can prepare the fund flow statement based on the 2 years balance sheet, previous balance sheet, and taking out what is a fund flow. The purpose is that whether the long-term funds are utilized for the long-term uses and leaving a certain portion to support the current assets or not. Long-term sources, a part of the long-term sources, we can call it as margin, or we can call it as net working capital. Net working capital or margin, that is excess long-term funds over long-term uses. So whether that is to support the current asset, it is there or not, that is to be seen. And similarly, we will have to see that as a lender has to see that short-term funds are not utilized for creating long-term uses of long-term assets. Thereby, diversion has not taken place. If the short-term funds are diverted, are taken for some unrelated activities, then that would be a siphoning. That involvement of siphoning would be there, whether these things have taken care of or not, the fund flow statement. Then we have also seen that cross-checking the stock statements, book debt statements as on the particular date, and the balance sheet. Suppose in the March it is submitted and the balance sheet received after 2-3 months or 4 months. Whenever you always have a comparative study, whether what is shown in the balance sheet and what is declared in the stock statement, monthly stock statement for the month March or September or December, whether it at least in tune or some major variance has not taken place. If that any such variance are there beyond 5% or so, then we should ask for the lender should ask for the explanation. Satisfactory explanation is not forthcoming, then other preventive measures to be taken care of. Then equally, that cash flow statement is also there. As cash flow statement, as a lender, the lender should, he should see that the installments or interest are serviced as per the terms of the sanction. From where these interest and installments would come? When cash flow is there, then only it will come. Cash flow relates to the cash, actual cash movement. It's inflow, that is cash inflow and cash outflow from the operations. So what is the net position? Mostly because it will cash inflow would be more. So that when the cash outflow includes whatever the interest obligations, whatever the installment obligation, everything would be taken care of, and accordingly the cash flow statement is prepared. Therefore, the business activities, the net position, based on that, then the net position would be drawn. And why this we are doing this, lender is doing this one, because that lender has to ascertain that the adequate cash flow is there from the operation adequate cash flow is generated, and that would take care of the interest and installments. So we can very well say that cash is a profit is only a mile. We cannot say that this much profit is there, so the unit our borrower would be able to make payment of, able to service the interest and installments. No, profit is there. It is only what we can say that profit is only a mile, but cash is a reality. So the lender will always see whether the cash movement is there. Cash movement is there, cash inflow is there, adequate to take care of the interest and the installment obligations. Similarly, cash, we can say that the profit is only an opinion, and whereas cash is the fact. It's an opinion only. But as a lender, we should give more emphasis, more importance, more priority on more thrust on analyzing these cash flow statements. These are the things which we already discussed in the part 1. Now coming to part 2, we will be discussing when we go for the rearrangement, we would be discussing this financial statement. What are the items where it should be classified? For that purpose, bank lender will always insist for the credit monitoring arrangement forms, CMA format. CMA, there are 7 formats. Out of that, there is form number 1 relates to the exposure from the banking system. Form number 2, it is an operating statement. Form number 3 is the analysis of the balance sheet portion. Then form number 4 is a computation of MBBF. Form number 5, assets and liabilities. Then form number 6 is the fund flow statement. Form number 7 is the project cost and means of finance. So these are the forms. Out of that, the second and third, that is operating statement and balance sheet statement, both are very important. So the balance sheet position is as per that is required, and that is to be analyzed by the banker while doing this loan processing. So we have seen that for rearranging the first CMA analysis should be, we can call it as CMA analysis, but here we don't have that much CMA analysis we are not taking care of. But how to rearrange in a balance sheet is concerned, in the balance sheet we have seen 3 liability side, we have seen that this one equity and liabilities, then non-current liabilities, then current liabilities. And instead of the 3 broad categories, here the rearrangement would be made in the CMA format, that form number 2, where the tangible net worth, the shareholders funds, that would be with the different items will come. Then long-term liabilities, then current liabilities and provisions. These are the rearrangements being done for the purpose of analysis by the lenders by using this balance sheet or the CMA format. Then fixed asset side we have seen 5 items. There we will be taking only fixed asset, then current asset and non-current asset, and all other items, non-current assets will be classified. Then miscellaneous expenditure also will come, that is intangible asset, that would be taken care in the rearrangement. Okay. Then so far as balance sheet, so the profit and loss is concerned, that we have to rearrange it in this format. That is particulars, the last year, rearrangement of profit and loss, and this year. The previous year, what was the position, then this year, what is the position projected. So based on that, here the first item is gross sales. Then gross sales, whatever total gross sales, including the excise tax or whatever it comes, that all the things will come, because invoices are being raised based on the gross sales total. Then cost of sales. Cost of sales, what are the inputs used in the, assuming that is a manufacturing unit, raw material, power and fuel, labor cost, other manufacturing depreciation. Then we will get the cost of production, because when we wanted to analyze the level of holding of the stock in process, the cost of production is being used. Then add opening stock of the opening stock, then opening stock less closing stock, you will get the cost of sales. That is what cost of sales, that is for calculating the holding level of finished goods, that is cost of sales. Then other head will be selling and general and other administrative expenses. Then we'll get the operating profit. Then interest, total interest burden, interest including bank interest and interest on unsecured loan or otherwise. But please keep in your mind that interest whatever paid should not be more than the interest paid to the lending institutions as per the directions. Then operating profit will get, then add any operating income less any operating expenses. Anything is there other than the non-operating income, non-operating income, non-operating expenses also, which are not related to the operations. Then the profit before tax, then tax will be added. The tax will be taken loaded and deducted, then we will get the net profit after tax. Taxation should be as per the budget announcement. What is the current this thing? And whatever things are taken, raw material and everything, cost, everything should be for the present year and future, this one, everything as per the current ruling price. Okay, this is the way the things are to be analyzed so far as profit and things are to be grouped for profit and loss account. Okay. Then while doing this process or exercise, what are some points, some items are to be recasted? For which are the items coming under the rearrangement? See, you must have come across this in the liability side, current liabilities, that installment of term loan due within 1 year. As per the directions, the installments of term loan falling due next 1 year should be taken as a current liability. But as a lender, when we do the rearrangement, because earlier it was there, then the Chamber of Commerce, Indian Chamber of Commerce represented to RBI, saying that whatever installments falling due next year, that would be paid from the income accruals of the next year. So why we are being penalized? So initially RBI has not agreed, then RBI has agreed some portion, then half of this one, then finally RBI has, because initially they were not relenting, then finally the pressure from the Chamber of Commerce, RBI has agreed that for the purpose of assessment of the limit, permissible limit, so far as working capital is concerned, installment of term loans due within 1 year need not be taken as a current liability, but it should be part of the current liability for the purpose of working out the current ratio. Current ratio, what is current ratio? Current asset divided by current liabilities. There, this aspect to be taken care of. But in the assessment, yes, we have to show it, and when assessment of the permissible limit, working capital, that much portion can be knocked out and realistic view may be taken. But in the current ratio, this portion should be taken as a current liabilities. Okay. Then comes advance tax and provision for tax. What is the practice? Guidelines says units or even for individuals also, we have to pay, we have to deposit TDS. We have to deposit advance tax quarterly or half yearly. We have to deposit it. That when comes on the balance sheet date, it would be an asset side. You know, it is an investment, but it is an expenses paid in advance. So it is an asset side. Whereas the provision is to be made based on the profit or profit worked out. The provision is also made there. That is a part of the current liabilities. So it is provided that it can be netted. Current this portion of this advance payment of taxes and the provision of taxes can be netted. We will get the net figure, and for this can be used when for the assessment part, because there is a great difference when the actual netting is taking place. The assessment, the eligibility would get changed. But in the normally by prima facie we do not realize. When we do the actual exercise, we'll see that that assessment would undergo change. So the guidelines say that when we take the netting, whenever we do the rearrangement, the netting should be done so far as advance payment of tax and provision of the tax. Then deferred tax assets and liabilities. Deferred tax assets, first of all, DTL means this is known as liabilities. Liability is nothing but the timing difference. So many times, the bankers are the units are permitted to submit the balance sheet. No, units are many times units will prepare 2 balance sheets. Sometimes some units will prepare 3 balance sheets. One based on the income tax rules, other one as per the accounting standard, and third time rare case that is for the purpose of the bank to availing more finance. That is not permitted. Only 2 types. It is 2 types of balance sheets permitted as per the income tax act and as per the accounting standard. So there the provision, there is a provision is made so far as tax liability, so far as means any timing difference. So suppose an item say depreciation maybe income tax rules may be more. Sometimes it may be less, but accounting standard it may be more or it may be less. The actual working, some units as per the Income Tax Act, they will prepare the balance sheet. Then same thing if they do it in the accounting standard as per the accounting guideline, accounting standard guidelines, then it would be different. There must be a different. If the tax liability, which actually it is paid more, and which is paid, suppose income tax, the provision, depreciation provision is taken more, and accounting standard is less. That means the profit has gone reduced to that extent, and the liability also means tax liability also reduced. Whereas in the accounting standard, the profit is increased, so the liability is there which is not paid, which would be paid later on. So the liability is created. Liability is created how? By debiting to the P&L by way of depreciation and crediting to the deferred tax liability. So deferred tax liabilities have to be either it is normally banks are taking as a net worth, the component of the net worth liability, and assets suppose other way around. Suppose the tax liability is more paid, then it's an asset. So that would be taken as an intangible asset, and that would be shown as an intangible asset in the balance sheet, the rearrangement time. Then non-moving inventory. Yes, if the inventory from the stock statements, we will come to know that whether the inventory is moving or not. If it is stagnant, means it is unsaleable and unusable, and for the purpose of getting this drawing power, these stocks are being shown. So that should be analyzed from the stock statements, where you have means 5-6 months stock statements, and if it is beyond some 6 months something, it should be shifted from current asset to non-current asset, so that this assessment can be made realistic. Then similarly, receivables more than 6 months. Receivables, as per the guidelines, if it is beyond 6 months, then it has to be shown as a non-current asset. But certain units, the operating cycle or the realization period may be more than 6 months. In that case, it is permitted. As a lender has to take the call whether the particular borrower, their period of the collection period is more than 6 months, then the lender can consider more than 6 months also. That is at the time of processing the proposal, it should be taken care of. Accordingly, it can be recommended or it can be sanctioned. Normally, otherwise, it should be beyond 6 months, it should be shown as a non-current asset, so that it will be taken care of while assessing the maximum permissible bank finance, permissible bank working capital finance. Then revaluation of asset. Yes, revaluation asset invariably it should be removed from the fixed asset, as well as normally it will be shown as the component of the net worth. It should be removed, or if it is there, it cannot be taken for valuation. It cannot be taken for calculation. But as per the Companies Act says, suppose the revaluation is retained in the business for more than 5 years, this can be taken as a part of the fixed asset also, and a part of the component of the net worth also. But most of the banks invariably do not accept the this one revaluation reserve. We call it as revaluation reserve as a part of the fixed asset or a component of the net worth. Accordingly, it should be knocked out in the CMI data from both the sides, not from one side, from both the sides. If it is one side, that means it won't tally. Bill purchase discount. It will come in the liability side. Of course, there is a finance availed, but it should not be included in the receivable statement. Or receivable statement, it can be shown by way of a separate note. This much out of this one, this much is the bills purchased or discounted. Because if it is included, that means banks, the lender is giving double finance. There also limit is fixed taking into account. So just to avoid the double financing, they should be shown by way of a footnote in the stock statement, by way of a note, this much is there. So at the time of drawing this drawing power, this item will be removed. That is a rearrangement. Then investment. Investments must balance sheet, it may be reflecting total investment. That should be ascertained whether it relates to the business or any investment made, whether it's a short term, it can be realizable within 6 months, then it can be a part of the short term asset, or else it should be shown as a non-current asset. The investment should be recasted, or we can say that rearranged in such a way that we can do the better presentation and better assessment of the need-based credit requirement. Will purchase. Then contingent liabilities. Contingent liabilities are invariably is a non-current. Is a neither a current asset nor a non-current asset. It should be by way of a footnote contingent liability. But we have to see if it is sale tax. This one, sale tax dues are there. If it is first, if it has gone, normally sale tax claims are coming. Borrower or our units may make an appeal to the authority, appellate authority. Appeal, they will go to the appeal. Appeal is rejected. Then also it can be shown as a intangible. Means it can be shown as a footnote in the balance sheet. Second time also they may make the appeal. Second time also it is rejected. Then also it can be shown as a note. But it is, if it is appeal is rejected beyond or declined beyond 2 times, more than 2 times, it should be shown as a current liability. That is the guideline. So recasting should be done so far as such contingent liability. Balance sheet, we will see that only contingent liability. But whether the contingent liability pertains to sale tax or any other item, these appeals have been declined, how many times it is declined, based on that, it should be shown as either as a note or as a current liability, or in some other items also, whether this item shown as a current intangible asset liability is having any impact on the performance of the unit. That also to be ascertained, regardless of whether it is a contingent liability or not. These things to be examined while doing the processing. Then provisioning. Provisioning, the profit is worked out, net profit, and when doing this one, it should be actual, based on the what is actually budget cut or whatever slab is given, based on that is worked out or not. Then accordingly it should be worked out. It should be, provision should be made. The depreciation method, it can be which method it is following. Either it's a written down value or straight line method. Written down value as per the Income Tax Act, written down value, accounting standard in the balance sheet, it is going as per the SLM method. So which method is going, whether it is properly taken care of or not, because these are the areas where juggleries can be taken care of. Then points to be and inventory valuation, it should be as per the current valuation. That is so far as the projections are concerned. Sales projections, when projections, as I told you, the lenders will always give the facilities based on the projections. Inventory valuation should be as per the rolling rate, not as per the previous rate plus some 5% or 10% inflation. No, current rate, what is the rate that it should be done. Sales projections, it should be reasonable, it should be realistic, and it is achievable. That is there. And the trend set should be there. Trend analysis would be carried out, and the best way should be based on the quantity-wise analysis. Those things will be when we discuss the working capital assessment. Those things will be discussed. Then sale process, current ruling, etc. Then spares, and spares in the other rearrangement also spares. There also it should be done. That imported items up to 12 months, yes, it is permitted. We can classify as current asset. Beyond that, it should be a non-current. Okay, indigenous spares, up to indigenous spares, we are taking only up to 12 months. Beyond that, we are not considering. Indigenous spares, we have to see whether it is 6 months or more, it should be classified as a non-current asset. Or we have to analyze always with the stock statement. Then spares, then expenses related to earlier years that would shown in the balance sheet. So that is not coming in the operating this one. It is an earlier years period. Then important events after the period. Then that how to analyze the financial statement. There are 3 methods prevalent. That is fund flow analysis. I already touched fund flow, how to do the fund flow, whether short-term funds are utilized for the short-term users or anything gone to the long-term users or not. Then long-term funds are a part of the long-term funds are utilized for supporting this current asset or not. That is fund flow statement. Trend analysis. Yes. What was the trend? How many percentage sales? How many percentage increase is there? Decrease is there? Any decrease? What are the reasons? Then ratio analysis. Major ratios to be analyzed. That is, we will see that liquidity ratio, solvency ratio, profitability ratio, all these things are to be analyzed, so that the trend, what is the trend, where any major variance, where the variations are taking place or not, we can come to the conclusion, we can analyze it. Fund flow, long time, as I already told you, the trend analysis, profit and loss, sales, operating statement, then when operating statement, then profit before tax, profit after tax, we analyze it. Consumption. Then when we go for the ratio analysis, profitability ratios, as I told you, liquidity ratios, capital structure ratios, then ratios indicating the ability to repay, that is ICR, interest coverage ratio, then DSCR, debt service coverage ratio, then turnover ratios, what is the turnover, but what is the maximum time taken for holding of the turnover. If it is speedily turnover, that means efficiency of the turnover management, or efficiency of the inventory management. Similarly, debtors collection period, if it is a less period, means efficient collection, efficient receivable management. Then similarly, creditors also collection period more, that means it is not efficient, but we are getting more credit by market credit we are getting.